Welcome to Williams Mullins Benefits Companion, a podcast that helps employers navigate the complex legal challenges of managing their employee benefit plans. I'm your host, Brydon DeWitt, and today I'll be joined by Scott Bailey, a partner in CPA with Carr, Riggs, and Ingram in Raleigh, North Carolina. Today we're going to be discussing captive insurance arrangements. How are you doing today, Scott?
I'm doing well, and thanks for having me.
We're really glad you're here, and this is really a very interesting and innovative topic of interest to a lot of our clients. Scott, why don't you give me a little background on who you are and your firm and the types of services that you provide?
Sure. So Carr, Riggs, and Ingram is a top 20 CPA firm. We're based out of the Southeast. Our headquarters being in a tiny little town that many people haven't even heard of called Enterprise, Alabama. But we've grown dramatically over the last 25 years to the size that we are now. Our footprint spans from North Carolina to New Mexico, and we service a variety of industries all over the map, from construction to healthcare to local government services, not-for-profit services, but where I'm the most active and where I have the most interest is in our insurance practice, particularly in our captive insurance practice. This is an area within the market that we've seen grow significantly throughout the country in the last 5 to 10 years as different states have looked into ways to bring some of these companies on board for some of the larger companies within their market. And it's starting to trickle down to the middle market. So this is an area where our firm is very active. We work within a lot of major domiciles within the country, and it's something that we just love to work with.
Yeah, this conversation is really a continuation of a conversation we had over a cup of coffee at a Starbucks, and I was really intrigued by what you were telling me about captive insurance arrangements. And so I guess to start off, just really at the beginning, what is a captive insurance company?
A captive insurance company is, well, as the name implies, it is an insurance company, but unlike what we typically think of when we're talking about insurance, our minds typically go to large carriers, nationwide carriers, and these large companies that everyone knows, either for buying discount car insurance with little creatures on television, or different healthcare companies, Blue Cross Blue Shield of name the place. That's where our mind typically goes. But what captives are, they're much smaller, and typically these are companies that are run. They all they do is insurance. If you were to look at the financials of these companies, it is insurance activity, and that's pretty much it. So these are companies that don't have employees or things like that. And the reason why they operate that way is these companies serve usually one parent company or a small number of other companies. So, what does that mean and how does that work? These types of companies have actually been around for quite some time, and captive insurance has been legal through the tax code since the early 70s. It's just been quiet in the U.S., aside from, interestingly enough, the state of Vermont, who was very proactive in being a captive domicile. Domicile meaning a state or territory where insurance companies are incorporated. So they've been around for a long time, and most of them have either been domiciled in Vermont or domiciled overseas. In the early days of captives, the IRS didn't really like the idea. They saw them as an opportunity for abusive tax shelters, and were quick to act in looking at those activities. However, as I said earlier, over the last 5 to 10 years, a lot of states have seen the value in these and have put in legislation allowing captives or have altered their legislation to promote captive activity.
And
at the current time,
yeah.
Go ahead.
Well, I was going to say, as as the name implies in captive, you said that it's basically an insurance company, and it has one parent. And so what's happening is companies, instead of giving insurance premiums to one of those large carriers, as you were describing, they form their own. It's what we call a captive, right? It's wholly owned for the purpose of providing insurance to that control group or to that group of related employers. Is that correct?
Yes and no. So in one way, yes, you're exactly right. And in other ways, it's just a little bit different. So as you say, most of them have either one parent or they have a small number of owners of that captive company. But the whole idea of them is to find ways to effectively transfer risk at a cost-effective rate. So these are really useful tools in managing all types of risk. Normally, we see them paired up with risk that's already being purchased on the commercial markets. So some of the early targets for companies starting captive programs range from medical stop loss with their health insurance plans to workers' compensation coverage to general casualty and loss coverages. So they can do a whole lot of different things. They can write coverages that you can't obtain through the commercial markets, usually called surplus lines in those cases, or they can be used to supplement insurance that's already available. So they're very, very flexible, both in their ownership and construction, as well as in the coverages that they're able to write.
Well, that's interesting. So when I think of captives, I think of it as kind of the next step to self-insurance. So as a benefits lawyer, of course, I'm focused on health insurance and how employers can efficiently provide group health plans to their employees. And employers of a certain size, it makes sense for them to self-insure. And so that's where they bear a risk to pay out of their own assets health claims up to a certain threshold. And then the employers will purchase stop-loss coverage from an insurance provider. And so when we were talking about captives, it seems like the captive arrangement is kind of the next step to that, where instead of having that outside stop-loss carrier, you form a captive. And I get, you're right. It doesn't have to be, one entity forming a captive just for that, that one employer. It can also be a group of employers, but it's kind of a closed ecosystem of managing risk in perhaps a more efficient way than sending a premium check to a health insurance or a stop loss carrier. I guess I was thinking really it's larger employers, but maybe not. I mean, what types of companies are best suited to exploring the captive option?
Well, historically, as I said, they've been legal since the early 70s. So I would say 100% of the top 100 companies on the NYSE have at least one captive in operation. Most of the Fortune 500, these things have been around for a long time, and there are a lot of large captive programs out there. The reason why we're seeing the growth that we're seeing is that captive managers and carriers who are fronting some of these activities have found ways to make them cost effective and bring them down to the middle market level. Brydon, I know you work with a lot of companies that fall in that middle large company tiering, I guess you would say.
Right.
And I think we both agreed over that cup of coffee that this is easily one of the most underserved markets. So they found a way to take these risk transfer methods and make them available to folks who just haven't had access to that market, either because of cost or complexity. And so as a result, we're just seeing tremendous growth. And you actually mentioned one of the areas where we're seeing a lot of growth and a lot of interest when you mentioned employee-related coverages, particularly medical stop loss. and other healthcare related coverages. It's no mystery to anyone what's happening with healthcare costs. And, we're recording this in late September, and people are getting their renewal rates.
That's right.
And this is when the interest spikes. So there's a lot of activity that I expect we'll see happening between now and the end of the year as it relates to these healthcare related coverages, workman's comp related coverages, and things of that nature.
Well, Scott, thank you so much for joining us on the Benefits Companion. This is a really interesting topic, and as you said, an area of growing interest regarding captive insurance arrangements. That'll wrap up our discussion today. If you have any questions or suggestions for future episodes, please contact me. You can also visit our employee benefits practice page at williamsmullen.com/employee benefits. There you can find out more about our team, as well as past episodes of this podcast and legal alerts. Be sure to subscribe to this podcast to be notified when our next episode posts. Thanks for listening.